Do you know that only about 20% of businesses for sale actually get sold? In today's video, we're gonna dive into that, and I'm gonna give you the top 5 reasons why businesses for sale don't sell, and why that it could be an advantage to the trained and discerning buyer like you. Let's get to it. Welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you are a small business owner looking to increase your wealth by buying a profitable business, or a W-2 employee sick and tired of the rat race wanting to strike out on your own as your own CEO by buying a profitable business, you're in the right place. Please subscribe to my channel and don't forget to hit the bell. You'll be notified every Thursday when new videos come out. Here are the stats on the percentages businesses sold. I'm going to give you in 3 different categories. For businesses that are under $500,000 purchase price, those with about 4 employees or less, usually 20% of those businesses get sold. For businesses that are between $500,000 and $1 million purchase price, roughly about 20% of those businesses get sold, usually between 5 to 9 employees. Now, for businesses that are at a higher level, where the purchase price begin at $1 million to $2.5 million and beyond, these are businesses that have been in business for a long time, 10 plus employees. 25% is estimated of those that sell. So the higher the purchase price, the most likely to sell, because of established businesses is kind of leading the way. So let's kind of get into the top 5. And here's number 1. Price is too high. This is really the biggest one. Now, for any for sale by owner type of businesses out there in which the seller has not validated the purchase price, the potential purchase price of the business, and goes out and puts whatever they want with not justifiable reason as to how they arrived at that price, that is the number 1 deal killer. I cannot tell you how many times, and we do mailers, we're talking to sellers all the time, and the biggest stumbling block of a seller is to get to a realistic value expectation, one that we know that we can actually sell. As a business broker, I cannot afford to take a business where what the seller wants, it's over here, and what I think the business is worth it over here. That gap is going to kill the deal. A lot of businesses out there, the brokers are not doing their job, and they're actually pricing them too high. I will not recommend to any buyer paying more than 3.5 times seller discretion earnings on any deal where the purchase price is $1 million. Why? Because most buyers are going to need some type of financing. Now, as the interest rates creep up on the SBA loan, more and more seller financer has to be there to meet the gap. If the seller really believes and is willing to bet on their own business, and the business can afford itself, the only way that's going to happen is with seller financing. So we're seeing a combination now of SBA loan, seller financing, and the down payment or the equity injection from the buyer. So price is too high at number 1. Number 2 is the books are a mess. Let me tell you, as an accountant, I'm first and foremost an accountant at heart. I'm a chief financial officer for hire for many companies, and I can tell you that whenever I come to an engagement, that's the number 1 thing that we're trying to fix, making sure that the business has good and sound financials. So I talk about it often enough in my videos. For those of you who already follow and subscribe to my YouTube channel, you know that I always rely and lean on good financials. The problem is when a business has been around for a while and the seller and the owner is getting ready to retire, and they haven't really done a good job keeping up with the books, which means the books are not you can't make sense of the books. There's, the gross margin is all over the place, the operating expense is up and down. You can't really make sense. You cannot really predict year over year what the expenses are going to be and what the income is going to be, and that lack of predictability makes a lot of buyers afraid. And frankly, I don't blame them. Now, to me, the ultimate litmus test of defensible financials will always be the tax returns. If a seller is unwilling to show the tax returns, there is no point in even trying to sell the business. So a lot of sellers or wannabe sellers are behind in their tax returns 2 to 3 years. Forget it. You first got to clean house. You first got to file your tax returns. Make sure that there is profit on the tax returns, because if there's no profit on the tax returns, what are you really selling, right? Yes, you can do add backs, you can take the negative losses, you can add back the depreciation, amortization, interest and taxes only if it is a C corporation, and whatever else is justifiable and agreed upon between lenders and the industry, those will add it back. But if the books are a mess, the business is not gonna sell. So here we go. That's 2 reasons why only 20% of businesses get sold. Number 3, customer concentration. Now I'm starting to see this a lot. So let's pretend that you find a business that is selling for 2 times cash flow. Say you found a really good business that is $1 million in revenue, $500,000 on seller discretionary earnings. Let's call that cash flow. So 2 times cash flow, 500,000, $1 million. Sounds, at least on paper, it looks good. So you're looking at a very profitable business. However, under closer examination, you realize that one particular customer has over 20% or more of the revenue for that customer. Guess what happens if there are no assurances that that customer will stay on after the business is sold and it walks away? There goes 20% of your revenue. Are you stuck trying to figure out how to buy a business? Let me help you. Let me provide you with some guidance. Let's hop in on a 15-minute call and just give you some proper guidance. All you have to do is reach out to me, either an email address, which is in the description section of this video, or you can just drop me a comment below. Either way, I want to give you some direction. That is my gift to you. Let's get to it. Now, and it's particularly critical. So if that business is actually earning 20% net income and that client goes away, that it's basically at most break even. So customer concentration, we have to, as business brokers, when we're getting ready to have businesses come out to market, we need to know exactly the biggest customers, the top 10 customers, how do they measure against the total revenue of the business. If any of them exceeds 10%, we need to know why, and we need to know what is the likelihood of that customer staying beyond the transaction. So for instance, if you are an owner and have been in business for 20 years and you have a customer that consistently gives you 20% or more of your revenue, but you have under a multi-year, say a 5-year agreement in which they are contractually obligated to give you that business. You know, it happens a lot in the government space for government contractors. Usually those are 5-year purchase orders with a 5-year extension. So you have backlog, you are already under contract, and the chances of that continuing is mandated by the contract. So whenever you have contracts, it makes the buyer, it makes everybody else, all the advisors feel a little better. But when the customer's concentration is there and the seller has not a very good job hedging their bets or finding other sellers to kind of limit, to lower the concentration of the customer, that's a reason the business is not going to sell. And I wouldn't advise a buyer. I have buyers come to me, and after a few minutes worth of discussion, and we talk about customer concentration, in which, you know, it's not uncommon to have one customer dominate 20, 30, or 40% of the revenue of the entire business. What kind of business do you have, right? So, you know, just word to the wise. Number 4 is financing. The number 4 reason, and you know, books are a mess was number 2, customer concentration is a 3. You can argue that financing could be higher in the ladder. But financing is, a lot of deals don't come through because the lender backs out. So the lender looks at the deal and, you know, they're taking their time and getting the application, and say we're looking at 12/31/22 financials, and so far the deal's on the fence, but then the first quarter of 2023 comes out and they actually have lesser revenue, and the debt service coverage ratio, it's less than the threshold that they feel comfortable with, then that could be a risky proposition for the lender. Now, lenders, what they tend to do is they look at the average of the 3 years. They look at the trending of revenue, operating expense, and net income over 3 years. They look at how the debt service coverage ratio would it look like in any of those 3 years if you were to superimpose the debt service, and what the free cash flow looks like. And so it's nothing is perfect, but it is a circumstantial case. As I said, they look at the whole thing, they figure, okay, the revenue and the profit went down in the first quarter, but look at the fourth quarter was great. Last year was great. Yeah, the prior year was a little off, but overall we feel comfortable with the risk. But if the lender doesn't feel comfortable with the risk, then you will not be able to remove the contingency of the financing. Lender backs out, you have no choice but to cancel escrow, and then there's no deal. Number 5, poor broker representation. Now, I'm starting to see more and more realtors, residential realtors, and even commercial realtors getting in the game of business brokering. Let me tell you, there is nothing like it. Real estate is different than commercial real estate, and commercial real estate is entirely different than business brokering. So a lot of sellers figured that they could actually get a better return on investment by paying a lesser commission to a realtor to represent him. And when I am, as a business broker, representing the buyer, and here we are, okay, you're interested in this business, and I start asking those hard questions, and the realtor doesn't really know what to do because they're really not thinking how to package a deal as a business. For instance, I would expect a business that has a purchase price north of $1 million to have a confidential business review or a confidential information memorandum, a CIM or a CBR, as the marketing brochure leading the way and the presentation of this business for sale that gives me all the high level points that I want to know in some summary of the financials so we can help the buyer make a decision. But when there's poor broker representation, this ties very closely to price too high. If the listing agent representing the seller does not do a good job validating the potential value of the purchase price, or what we call the opinion of market value, and they price the business too high, it's not going to sell, right? Buyers are becoming increasingly aware of how metrics work and how cash flow works. So you have to be at a price that is reasonable. It's a reasonable. And how do we do that? We do that by multiple software services that we use that gives us comparable market sales. So we go with market value. First and foremost, we want to know what is the market saying that this business is worth, and what is the low, the medium, and the high, and can we stay in the medium, the 50 percentile of businesses that sold, say, at 3 times cash flow. It's what these businesses in this industry and this NAICS code actually go for. That is a validating assumption of what our business could sell for. So once we have all that, we know what the similar businesses are selling for. Then we know what other market data and intelligence is telling us. We know what industry reports are telling us. Then we put the whole thing together and we come up with our own opinion of market value, what we think the business can sell. There's no point in putting a business for sale if we don't think it's going to sell, right? If you're going to put it out there, just hopefully somebody will be stupid enough to buy a business that doesn't make any sense. The shame on the buyer, good for the seller. Okay, so hopefully that was helpful to you guys. Thank you so much for subscribing. Let's do this. Limited time, I'm giving away my cash flow calculator. This tool in Excel has been downloaded hundreds of times by buyers like yourself. What allows you to do is you can take any businesses for sale from anywhere, and you can plug in the numbers, and you can figure out what the optimal debt service would be and what the cash flow would be if you plug in all these numbers, so you can go into any deal with eyes wide open. I call it the Deal Analyzer. That version is a complimentary version. All you have to do is click on the link below. It's yours to keep, and let me know how it's working for you. Thank you.